As some people are focused on Bitcoin and others are focused on Ethereum, governments and regulators around the world are focused on regulation of cryptocurrencies and blockchain technology. So as you and I are focused on cryptocurrencies and blockchain technology as a whole, what are the fundamental differences and ways that the traditional banking system is recognizing Bitcoin and cryptocurrencies versus blockchain technology? Let's discuss. Hey everybody, I'm Gary Palmer Jr., you're you, and together we are Minting Coins, your trusted source for crypto news, interviews, and ICO reviews. Thank you for showing up. Tap that like button. It really supports us and it helps other people find this content. Also, if you have any questions or comments, leave those in the comments box below so that your voice can be heard as part of the community. In today's episode, we're going to be talking about the ramping up of blockchain technology in 2018. We are definitely noticing this bullish sort of tendency in the market. We see the prices escalating across Bitcoin and Ethereum and a lot of awesome blockchain projects. At the same time, there's a lot of trepidation from people to get into the market as we haven't quite yet broken through that $10,000 Bitcoin price. We have Ethereum on the cusp of regulation being deemed as a security or not a security. And all around the world, we continue to see governments being for and against Bitcoin and blockchain technology as a whole. We're starting to see the fundamental differences in the way that they're parsing their thinking, the way that they're looking at this technology, and the way that this thinking structure is moving from regulators through governments and all sorts of institutional investors and organizations that are involved in the banking world. We're going to be going over some of those headlines, and in doing so, I think it's important to recognize where are you in your understanding of this technology and participating in this next level of the internet, this next level of human and machine interconnectivity with these new tokens, these new digital assets that allow people to have new levels of freedom, new levels of sovereignty, new levels of being able to participate with each other in a decentralized way without requiring third parties, without requiring permission, without requiring the restrictive red tape that allows people to get involved into the different aspects around the world. And so as we're going over this information, not just in today's episode, but in, all of our episodes, where do you want to be 5 years from now? Where do you want to be 10 years from now? And on your path there, are you understanding the differences between Bitcoin, the token, and Bitcoin, the blockchain? And so there's this fundamental difference that people are trying to separate the two when ultimately they're they're essentially the same thing. They're almost the same thing. They're interconnected, but people are trying to take the blockchain out of Bitcoin, trying to create their own, version of the blockchain that's ultimately not really decentralized, not really the full capabilities, doesn't come with the full power of blockchain technology. That's why they call it distributed ledger technology, or these different types of private blockchains that, are trying to give corporations and governments what they're looking for, but still, take advantage of the efficiency of, blockchain, the efficiency of this distributed ledger technology. And in that process, as many hundreds of thousands or millions of people across the world are having this hesitation to get into Bitcoin because of this disparagement of what's saying, the bankers are buying up Bitcoin, the governments are buying up Bitcoin, the institutional investors and the wealthy are transferring their wealth into Bitcoin. And while everyone else is staying on the sidelines being told, hey, don't touch that, that's not cool enough. Well, with that being said, let's dive into some of our headlines, take a peek around, and let's discuss. First off, just to continue for a second, When we're exploring this technology and getting involved in this technology, it's not that Bitcoin is going to change our lives by itself. It's not that Bitcoin is this little bit of magic or this magic bean that you just put in your digital wallet and everything is going to instantly be better. Instantly doesn't really happen. Instantly is usually a scam. This is a long-term game. People are talking about the Bitcoin price mooning up from where it's at now, from about $10,000 to $1 million. And they're talking about that happening in just 2.5 years. I don't know if that's going to happen in 2.5 years. It can go up, it can go down. No one really knows. But what the people who are explaining this technology, the people who are developing this technology, the people who seem to understand this technology the most, recognize that the long-term strategy is about holding, and it's not about short-term gains. It's not about short-term increases and just instantly having Lamborghinis and caviar dreams and all that jazz. So don't necessarily just ask what can Bitcoin do for you. Ask what can you do for Bitcoin? What can you do for decentralized technology, for blockchain technology, for promoting and helping other people understand what is Bitcoin, what is a decentralized wallet, and maybe introducing people to information so that they can make decisions as well as you understand information and you may be buying and holding Bitcoin already. So before we dive into the meat and potatoes, NBA superstar Stephen Curry has signed a deal to release his own CryptoKitties. So CryptoKitties is getting a little further mainstream. It's going to be permeating the minds of a lot of additional people who aren't familiar yet with Ethereum or CryptoKitties. They are familiar with the NBA, they are familiar with Stephen Curry, and they are going to be hearing that Stephen Curry has these CryptoKitties. Here's the 3 CryptoKitties right now, and this is just going to help increase the awareness of blockchain technology, of these fun sort of crypto collectibles. And as people are introduced into the crypto collectibles, the crypto games, the STEEMITs of the world, and some of these applications that are easy to use and fun to use, then more and more people will get introduced into Ethereum, they'll get introduced to Bitcoin, and it will open up their minds into asking these additional questions such as what is money, what is trust, what is security, what is privacy. And this is a slippery slope that everyone is moving down. And this is a slippery slope why governments around the world are really concerned about Bitcoin and Ethereum, which we're going to be discussing. With the CryptoKitties, these are ERC 721 tokens, which means that they are non-fungible, unique assets. Fungible, if something is fungible, that means that one thing that's fungible is the same as another thing that's fungible, like a dollar bill. There's really no difference between this $1 bill and that $1 bill, and so those are fungible. But if you have baseball cards and you have 2 Babe Ruth baseball cards in different years, or you have just 2 different people's baseball card from the same year, each of those are unique assets, unique physical assets. But in the blockchain world, these CryptoKitties are non-fungible digital assets, which means they're each unique. And these are 3 one-of-a-kind CryptoKitties, which could increase in value as the popularity of CryptoKitties increases and the scarcity of these CryptoKitties decreases. But in the recognition of CryptoKitties, we have to realize that there's a big difference between the CryptoKitties use case and Ethereum, and what the possible Ethereum use cases are, what the possible use cases are for Ether, the token, or ETH as some of us call it. And when regulators are looking at Ether and Ethereum, and when they're looking to see if Ethereum, the Ethereum ICO in 2014 was a legal security sale or an illegal security sale, there's a lot of stress right now in the Ethereum community that the SEC and regulators in America could deem that the Ethereum ICO was an illegal securities crowd fund. And if that happens, what sort of doubt and uncertainty, confusion could that cause into the market that could send the price down, could restrict development and opportunity within America, and then could push this development further outside of America? And then what would that mean for systems like CryptoKitties, where, CryptoKitties just received a $12 million investment a couple months ago for them to continue producing cats on the blockchain. And this is a US-based company at this point. So this regulatory body is going to be meeting there. It consists of people who are part of the SEC, the CFTC, probably some other organizations as well, perhaps FINRA, and they're going to be deciding, what is the decision, and that's going to be helping to decide what is the future for Ethereum. There's a lot of people who are arguing that Ethereum is not a security for different reasons, because it no longer meets the definition of the Howey test, because it was such a unique situation at the time that there was really no precedent for it. Or a third quick reason would be, perhaps because of the fork between Ethereum Classic and Aetherium, that Ethereum Classic is actually the original ICO security, and that, Ethereum ETH would just be a derivative of that. There's a lot of ways that this could, go down, and any one of those could be true, and yet the SEC, the CFTC could give Ethereum a pass because it's already so big, because there's a lot of business owners and regulatory agencies, banking agencies, corporations that are using the Ethereum blockchain, and they wouldn't be good for business necessarily for Ethereum to be deemed a security. The Ethereum Foundation has responded saying that the Ethereum Foundation does not control the supply or demand of Ether, controls less than 1% of the total amount in circulation. And then also, since Ethereum is mined, they have no control over the token itself. So another reason why I think that this is really interesting is because Bitcoin BTC has largely escaped regulatory oversight because of the unique organic way that Bitcoin has grown to be the behemoth that it is. Where in contrast, Ether and Ethereum and the Ethereum Foundation sort of have been there to grow, have been there to raise money, have been there to use that money to build the Ethereum blockchain. Now, it's important to understand what's happening and what are the differences here. Well, there is blockchain technology like the Ethereum blockchain, like the Bitcoin blockchain, and then separate from that, you have the Ether token and the Bitcoin token. The regulators around the world, we're hearing over and over again, they're very, very interested in blockchain technology, but they're not interested in Bitcoin. They absolutely want to separate the two because Bitcoin removes their power. Blockchain technology actually gives them power. And if they can take over as much of the blockchain technology as possible while pushing away the Bitcoin, then that's going to help them maintain their supreme dominance over the world and the world banking system, forever to come. And this explains why we see incredibly large institutional investors and incredibly large institutional organizations, corporations that are vehemently against Bitcoin and the Bitcoin blockchain. They see it as the rat poison for the world because these organizations, which have been, consuming and feasting upon everyone's labor, everyone's time, everyone's purchasing power into goods and services, well, these systems which have been, gnawing their ways into the baseboards of the American foundation, these systems could be seen as rats. And so if these systems can be seen as rats, then it would make sense that Bitcoin is rat poison because Bitcoin is directly opposed and poisoning those existing systems. So as we see news that Goldman Sachs is going to be opening up a Bitcoin trading desk, and they're with one side of the mouth, they're opening this Bitcoin trading desk, but with the other side of the mouth, they're saying that they're not big believers in Bitcoin. They are simultaneously doing one thing with their actions, saying another thing with their words. And a result of all this is that we have Nick Colas here, who is the co-founder at DataTrack Research and the first Wall Street brokerage analyst to cover Bitcoin BTC. He recommends that investors reconsider any investments in buying into Bitcoin. He is not a believer in Bitcoin. He says banks and investors, institutional or from Wall Street to Main Street, should not be involved in Bitcoin because of the risks involved in Bitcoin, because there isn't engagement, because there isn't the same growth that we were seeing in December as we are now. What Nick wants us to do in his recommendation is that essentially, if you read into it, is that he wouldn't recommend that anyone get involved into Bitcoin until after it's too late, until after the institutional investors purchase into it, after the numbers increase, and then causing people to lose their position in this opportunity. Now, this is in direct contrast to what Spencer Bogart says, who is a blockchain venture capitalist. He puts out there that there's a real risk, a huge risk, that some of the existing companies in blockchain technology, the Coinbases and the Binances of the world, could overtake some of Wall Street's biggest banks if the Wall Street biggest banks don't get involved in a cryptocurrency market. So the banks are getting involved, but the banks are reluctantly getting involved. They're getting involved in the Bitcoin because they recognize that the growth of Bitcoin may continue to be exponential. So as they're telling institutional investors to don't get involved in Bitcoin, they themselves are moving into Bitcoin. They themselves are getting involved in Bitcoin, while they also want to overtake the technology as well. Recently, we reported that the state of Arizona passed a law that allowed anyone in that state to pay their taxes with cryptocurrencies. Well, since then, there's been an amendment, and the amendment now only requires consideration of acceptance of the cryptocurrencies. So they received some pressure, it seems, and now because of that, it's not going to be a sure thing that people are going to be able to pay their taxes with cryptocurrencies, even though the state is still going to be open and accepting the blockchain technology in general. They haven't completely opened the doors because of the pressures and because of the risks that the governments and the regulators would have to experience giving up control from their systems to the Bitcoin, the decentralized Bitcoin blockchain. And this isn't just in America, this is also in China. For example, according to Desmond Marshall, who's a managing director, he said that when talking about blockchain in China, it's important to make the distinction between cryptocurrency and blockchain. He goes on to say, in terms of blockchain technology itself, China is quite open and welcomes this kind of discussion. But of course, if we're talking about cryptocurrencies or ICOs, that's a definite no-no. I was just recently listening to the Kaiser Report, and in that show, what was being talked about was that there was recently a blockchain conference, and the first half of the conference, they were talking about blockchain, and there were 1,000 people listening to that discussion. And once they started talking about Bitcoin and decentralized wallets and how people could create their own decentralized wallet, the government came in and immediately had everybody leave. 1,000 people had to leave this conference because they wanted to increase the discussion about blockchain technologies, but not increase the discussion around Bitcoin and getting people to be have a vehicle for transitioning their fiat money out of the country, out of the yuan or the muimbi, and into a blockchain technology. This is not something China wants. This is not something that the United States wants. This is not something that any world government or regulator is excited about. They're excited about the blockchain technology. They're not excited about Bitcoin. They are not excited about decentralized technologies in general. We are seeing that all over America. We're seeing that all over China. And last but not least, in today's show, we are also seeing that in Japan. So Japan's FSA wants to get Monero, Dash, and Zcash removed from all domestic exchanges. What's most interesting about that is that cryptocurrency is legal tender in Japan. Everyone is able to buy and sell with Bitcoin and cryptocurrency, yet some of these ultra-private cryptocurrencies are not wanted in Japan. They want to get them off the exchanges. They don't want people to be able to easily own these and easily transact in these, because Bitcoin, they're able to monitor every single transaction. They are able to monitor, even a transaction that's completely private is going to eventually be, most likely eventually be connected to a transaction that is connected to someone's identity. But with Monero and Dash, that's not possible or easily possible, if possible at all. And Japan wants to remove all of those from the domestic exchanges. Ultimately, we don't know if the exchanges are going to follow these instructions, if they will remove these cryptocurrencies willingly, or if they're going to be forced to remove these cryptocurrencies by the Japanese government. by the Japanese Financial Service Authority, the FSA. But it's going to be really interesting to see how this continues on, especially in contrast to America, where in America, there's this trepidation around Ether, Bitcoin, all cryptocurrencies. In Japan, where Bitcoin is legal, there's this trepidation against the privacy tokens. It's going to be really interesting as the price balloons and blows up potentially, what additional restrictions start falling on people that help them realize the harsh realities and differences to compare and contrast the fiat currency with some of these decentralized currencies sooner rather than later. So I think the long-standing theory that people are sort of moving toward is that Bitcoin and Ethereum and tokens like it may become digital assets that you need to be like an accredited investor to own, an accredited investor to purchase into. And then they'll have different sort of tokens that, the common person will be able to own and buy into, like FedCoin, for example. Maybe small amounts of Ether will be okay in order for us to operate and purchase our crypto kitties. But then, Bitcoin and privacy tokens may be shunned against, or, there could be laws that, say that they're completely illegal. And if that was to happen, then what would that do to the Bitcoin price? Well, when something becomes totally legal, then the price usually goes up because then the adoption and growth can accelerate. And at the same time, when something becomes completely illegal, then we see the price go up, and then we see, the adoption sort of increase. It's just how humans are, right? When something was illegal, then everybody wants to be a part of it. Part of this is the reason why Bitcoin and blockchain technology isn't 100% legal or 100% illegal yet, because of what that would do for the price. As long as there's this middle ground where no one knows what the hell is going on, that's going to keep, so much confusion and uncertainty for businesses and consumer investors that it keeps the price more stable than not, because people don't know what's going to happen. They aren't sure what's going to happen, and that just creates a lot of additional hesitation as people wait for other influences, other factors to put pressure on that price in, an upward or downward trajectory. So I'd love to know, what do you think? What do you think about the differences between the cryptocurrencies, the tokens, and then blockchain technology? What do you think about governments around the world trying to separate these two? And do you think that they're going to be successful? And if they are successful, wow, is that just going to push the innovation out of those countries? Regulators must realize that there's a risk of stifling education and adoption and technology and economic growth if the new Silicon Valley, if the blockchain valley actually springs up in Dubai or Moscow or Beijing, then America could be out for the next few hundred years in terms of being at the center of that growth. It's good for the world that the world is involved, but it's going to be bad for Americans in America if American companies and American citizens can't get involved. It's going to be really interesting as the economy continues to go up, or if it doesn't continue to go up and goes down, what that debt does on the country. There's so many variables. There's so much to pay attention to. Let me know, what do you think? What did I miss? And what do you agree with? What do you disagree with? And until next time, I'm glad that together we are minting coins.